Yeah, overall, based on our estimates, is that with prior to what was discussed last night in terms of this additional 50%, overall drop, sort of when we have tariff levels are hovering around 50 to 60%, it's going to be roughly about a 1% decline for China's overall GDP. So in order for China to maintain that 4.5 to 5% GDP for 2025, there's going to be a lot more that needs to be done in terms of overall stimulus, in terms of push on consumption, which then, we really need to see specifically how that will be imposed in order for China to maintain at that 4.5% GDP level for this year.
Stimulus needs to be forthcoming. The Chinese authorities have tried a lot. They've thrown a lot at the Chinese economy. The cash for clunkers, for example, that has worked to some extent. How much more can they do?
Yeah, I mean, the thing is that, we need to see more specifically around consumption, in terms of how we can see further consumption push. I think the one thing that people have been speculating more and more, especially, is where are we going to be around the renminbi? Now, the fact is that is China potentially going to further devalue the renminbi in anticipation in terms of more tariffs in order to maybe offset some of these tariff rises, which is happening? That could be a potential notion there. But with that said, we still need to see whether or not and how the tariffs will be impacting the overall Chinese economy, because overall, while interest rate levels are very low, there's still very much a fragile stage in terms of trying to push up consumption, trying to increase overall capital expenditures. These are all going to be important aspects, because ultimately the fact is that while yes, a lot of exporters will try to find ways to maneuver around some of these tariffs, which are going to be imposing quite heavily. Overall, what's the capital expenditures? How is total capex going to be translated, especially if there's expectations that overall productivity and manufacturing is going to be weak? So in particular, when we look at certain areas like electronics, in terms of housing appliances, these will be impacted quite a bit, as opposed to some of the other sectors such as financials or such as specifically utilities. These sectors tend to be a bit less exposed in terms of exports. And so as a result, those might be areas that we're focusing a bit more of our attention on right now, especially with those sectors, that has or is actually very limited impact around tariffs.
Yeah, so Ken, I'm going to get you to be a bit more granular at the moment. What are you doing? Because, I mean, obviously there are two schools of thought. One, ride this out, wait for it, pay more when you know more about the situation. Others are saying the bottom's in. It's very, very interesting opportunities to actually pick up in the market. What are your thoughts? Tell us, Ken.
Yeah, it's very difficult to catch a falling knife at the moment, right? The fact is that when we look at specifically some of the opportunities right now, we feel that the domestic A-share markets are and actually tends to be a bit more defensive, especially around when times are volatile. You look at the domestic A-share as compared with the H shares here in Hong Kong. Right now, they're trading at, I would say, fairly low levels in terms of overall premium. And so this is kind of where we look for opportunities. The other thing we're also looking for potential opportunities, especially over the next couple of quarters, is a potential re-rating of some of the old economy sectors. The fact is that with this recent rally that we've seen over the past 6 months prior, what we have seen is that a lot of the technology stocks have seen quite a bit of a re-rating, but a lot of these old economy sectors really haven't seen any re-rating at all. And right now, with some of the defensive postures, and specifically around the fact that the Chinese central government is actually trying to inject more capital and liquidity into the system, purchasing more ETFs, purchasing specifically some of the larger names, a lot of these old economy stocks might actually stand to benefit. So we're focusing on those particular names, looking at specifically names that actually are generating a slightly higher dividend yield are also areas that we're focusing on, especially given some of the uncertainties that we're still going to be facing in the near future.